This is a presentation on the urgent need for pension updation for State Bank of India pensioners, who dedicated their lives to building the nation's premier public sector bank. It highlights the issues faced by SBI retirees and the compelling reasons for immediate and fair pension revision. It is an appeal for justice, equality, and dignity by Umesh Sharma on behalf of Group of Pensioners, State Bank of India. This video is conceptualized and created by S. Satyanarayana, Chief Manager, Retired, SBI, Hyderabad.
Late Shri P. Ramchandra Upadhyaya, Retired General Manager, SBI, Mysuru, was the founder of the Group of Pensioners and a tireless champion for SBI retirees. A scholar, Vedic astrologer, and legal mind, he dedicated his post-retirement life to securing pension justice. His work on issues like family pension, DA neutralization, and pension updation laid the foundation for major reforms. He passed away on 19th September 2020, leaving a legacy of service, sacrifice, and inspiration.
Despite decades of meritorious service, senior SBI pensioners face injustice. Their pensions remain static, even as costs rise. Seniors receive less than juniors with no mechanism for revision. Unlike other banks, there is no negotiation forum for SBI retirees. Nearly 3 lakh pensioners, many aged above 75, are now facing severe financial hardship. SBI's pension system has deep historical roots. It began in 1829 with European officers of the Bank of Bengal. This privilege continued under the Imperial Bank and later under SBI after nationalization. Section 50 of the SBI Act 1955 empowered the bank to frame its own pension rules, distinct and independent. The SBI pension scheme is bank-specific, approved by the central government and fully funded by the bank. Monthly contributions equal to 10% of salary are made. Pension is calculated as 50% of the average of the last 12 months' salary. The fund is actuarially valued every year to assess its long-term sustainability. Family pension is paid at 30% of last drawn salary. The scheme is self-reliant and professionally managed, ensuring financial stability and regulatory compliance.
Key milestones of the SBI pension scheme. 1829. Discretionary pensions began for European officers in presidency banks. 1921. Imperial Bank of India formed. Pension introduced with Rs 200 to Rs 750 limit. No family pension or DA. 1931. Pension made contributory at 5% by employees, with the salary ceiling of Rs 1,800 introduced in 1932. 1955. SBI was established. Statutory pension scheme launched under SBI Act. Dual rules for IBI and SBI retirees. 1968. Employee contribution stopped. Bank began 10% monthly contribution. 1972. Gratuity introduced under the Gratuity Act. 1980. Pension rules codified. 1986. Uniform pension formula introduced. Ceilings raised. Family pension scheme launched. 1987. Dearness relief on basic pension introduced, linked to CPI. 1993-95. Pension scheme introduced in lieu of CPF for other public sector banks. SBI pension scheme widened. 1999. Dual pension formula. 40% and 50% introduced. 2007. Family pension slabs revised. 2010. Contributory pension scheme introduced for new recruitees. 2014. SBI Pension Fund regulations notified. 2021. Family pension revised to 30% of last drawn basic pay, with no ceiling. 2022. Monthly ex gratia payments introduced. 2024. Pension regulations amended.
Central government pension reforms through the fourth and fifth pay commissions introduced percentage-based increases, notional pay fixation and inflation protection, establishing the concept of modified parity in pensions. The fifth pay commission granted revised pensions as 50% of notional pay, effective for all retirees. Additional pensions for senior citizens were introduced, ensuring fairness and inflation adjustment for aged pensioners. After litigation and Supreme Court directions, the government approved pension updation for RBI retirees in 2019. It was funded entirely by RBI's pension fund. No burden on the government budget. NABARD pensioners also benefited from the RBI formula. Pension updation was granted in June 2023, continuing the trend of parity in public financial institutions. Unlike the RBI and NABARD, SBI, a frontline banker with historical significance, remains excluded from pension updation benefits, despite playing a central role in India's financial system. While RBI and NABARD are regulatory and refinancing institutions, SBI is the frontline banker to the nation, with a much larger retiree base and a legacy of nation building. Historically, before the Reserve Bank of India was established in 1935, the Imperial Bank, later renamed as the State Bank of India, performed several quasi-central banking functions. Despite this legacy and critical national role, SBI pensioners have been unfairly excluded from the pension updation benefits granted to RBI and NABARD retirees. Outdated pension levels have led to economic hardship, inequality, and emotional distress among SBI retirees. Senior officers earn less than juniors. This violates constitutional principles and affects morale and dignity.
The Tangirala Committee report, meant to address pension updation and DA neutralization in SBI, has unfortunately emerged as a case study in a skewed process, yielding an unjust outcome. To begin with, the committee violated its own terms of reference, as laid out by the Department of Financial Services. Pension updation and DA neutralization were core components of its mandate. Yet, these issues were summarily deferred, not based on stakeholder input, but solely on the suggestion of the Indian Banks Association. But here's the flaw. The IBA is neither a statutory body nor a stakeholder in SBI pensions. It is merely an association of banks without any role in the formulation or administration of SBI's pension scheme. Its opinion is not binding, nor is it representative of SBI's unique statutory framework under the SBI Act. Incredibly, the committee chose to consult only the IBA, while excluding SBI itself, the actual employer and trustee of the pension fund. No effort was made to obtain SBI's official views. This omission undermines both the procedural fairness and credibility of the committee's conclusions. Equally serious is the complete disregard for ongoing legal proceedings. Despite active writ petitions before the Delhi High Court, the petitioners were not consulted. This exclusion violates principles of natural justice. It is well settled in law that sub judice status does not bar policy deliberation, provided there's no attempt to preempt judicial decision-making. Furthermore, the committee's internal decision to drop critical issues was made without transparency, no recorded dissent, no published rationale, and no stakeholder dialogue. When decisions affect the lives and dignity of lakhs of senior citizens, such opacity is unacceptable. In summary, the committee's decision to exclude pension updation and DA neutralization was procedurally flawed, legally indefensible, and driven by undue reliance on a non-stakeholder. It breached its DFS-defined mandate, ignored rightful stakeholders, and compromised the fundamental principles of justice, equity, and institutional accountability.
The Honorable Finance Minister, while inaugurating the annual general meeting of the Indian Banks Association, emphasized the need for one rank one pension for bank pensioners. This public statement clearly indicated the government's conceptual acceptance of pension updation parity. Meanwhile, the Indian Banks Association continues to maintain its objection, citing industry-level policy limitations. The key demands raised by the United Forum of Bank Unions and the corresponding responses provided by the Indian Banks Association have been furnished here. With regard to the demand for pension updation, the IBA replied that it was impossible to consider due to the huge cost involved. However, the unions suggested gathering data on pensioners and assessing the actual cost so that a workable solution could be explored. Regarding the periodical improvement or updation in pension to coincide with wage revisions, similar to the central government model, the IBA replied that the pension scheme was a funded arrangement in lieu of contributory provident fund, and hence providing for periodic revisions would not be possible, as it would severely impact the financial operations of banks. In essence, while the unions pushed for fairness and parity, the IBA repeatedly cited cost and structure-related limitations to defer or reject these demands. In the MCC Singla case, Special Leave Petition Civil Number 5561 of 2016, the Indian Banks Association filed a sworn affidavit opposing the updation of pension. A key excerpt from the affidavit reads, "It would neither be appropriate nor possible for the banks to consider the request for updation of pension." The IBA cited two primary grounds: financial non-viability and industry-wide policy constraints. Unfortunately, this stance adversely impacted State Bank of India retirees, despite the fact that SBI has an independent pension scheme separate from other public sector banks.
The objection that the issue is sub judice doesn't stand to reason. The Honorable Supreme Court has made it clear The pendency of a case does not restrict policy discussions or executive action. Dialogue, preparation, and decision-making outside the courtroom are not contempt. Governments and institutions are expected to continue functioning, and that includes addressing pension updation without waiting endlessly for litigation to conclude. Multiple Supreme Court judgments confirm that litigation does not block governance or policy action. In Kripak and Bennett Coleman, the court ruled that administrative decisions and policy-making can continue unless a judicial stay is issued. In Ashok Kumar Thakur and ADR cases, the principle is reaffirmed. Policy discussions and reforms must proceed despite ongoing cases. This clearly validates that SBI or IBA can negotiate and prepare for pension updation, even if the matter is before the court. Courts have consistently held that pensions are a right, not a charity. In Nakara and SPS Vains, the Supreme Court ruled that pension must evolve and ensure parity, regardless of retirement date. The RBI officer's case confirms that revision is valid even without an explicit provision. Jagjit Singh extended the equal pay for equal work principle to retirees, strengthening the case for fair and revised pensions. Together, these precedents establish that absence of a clause does not block pension updation. Across India, both central and state governments have revised pensions, even under fiscal pressure, setting a strong precedent. The Supreme Court, in the Nakara case, clearly ruled that financial constraints cannot justify denial of pension benefits. Therefore, the IBA cannot use the excuse of financial strain to withhold rightful pension updation from bank retirees. Before updating pensions, both central and state governments were under fiscal stress. The central government implemented the 7th Pay Commission in 2016, despite an average fiscal deficit of 4.5% and rising debt from Rs 46 to Rs 62 lakh crore. States like Kerala and Tamil Nadu also went ahead. Kerala accepted the 11th Pay Revision Commission in 2019, while Tamil Nadu aligned with the 7th CPC in 2016. Andhra Pradesh and Telangana followed later, despite tight budgets and increasing debts. This shows a consistent pattern. Pension revision was prioritized even under financial pressure, underscoring it as a matter of commitment, not just capacity. Despite varied fiscal conditions, several governments went ahead with pension updation. The central government, with a 3.9% fiscal deficit, implemented full notional updation. Tamil Nadu, Kerala, and Karnataka also followed with full implementation, even under moderate to very high debt. Telangana and Andhra Pradesh opted for partial updation. Telangana with arrears, and Andhra Pradesh through a fitment-based revision, despite severe financial stress. This highlights that pension updation was prioritized not just based on capacity, but on commitment to retirees. Between 2011 and 2021, the central government consistently faced high fiscal deficits and rising public debt, crossing Rs 95 lakh crore by 2020-21. Yet, it implemented the 7th Central Pay Commission and fully revised pensions in 2016, even under financial stress, from subsidy burdens to inflation, and later the COVID crisis, there was no rollback. This reaffirms the centre's commitment to pensioners, proving that fiscal pressure didn't stand in the way of justice to retirees. Despite fiscal deficits and rising debt, states like Kerala, Tamil Nadu, and Karnataka fully updated pensions. Others like Telangana and Andhra Pradesh followed partially, proving pension revision was upheld as a constitutional and social duty. Despite 5 years of fiscal stress and rising debt, Andhra Pradesh implemented pension updation in 2022 using 23% fitment and demerger, reflecting limited notional revision. Kerala implemented pension revision in 2019 with 8% fitment and notional fixation, despite high pension burden and severe fiscal stress. Tamil Nadu revised pensions from January 2016 with full CPC parity, despite debt of Rs 2.6 lakh crores and a Rs 24,000 crore pension bill. Despite no fiscal gains and debt over Rs 2.7 lakh crores, Telangana revised pensions from July 2018 with 30% fitment and DA merger. SBI's pension fund is built on strong financial discipline, with annual actuarial reviews ensuring stability. With sufficient reserves and consistent contributions, there is no valid reason to deny a more favorable commutation factor, which would benefit retirees without straining the fund. As on 31st March 2025, SBI's pension fund liability stands at Rs 2.04 lakh crore, with assets of Rs 1.67 lakh crore, reflecting a book deficit of Rs 37,000 crore, fully recognized in its balance sheet. Despite this, the bank continues to meet annual pension and commutation payments, maintaining financial discipline and transparency in provisioning. Over the past decade, the SBI pension fund has shown consistent and remarkable growth. From Rs 51 crores in 2015 to 16, the fund has steadily increased year after year, reaching over Rs 2 lakh crores in 2024-25. This nearly fourfold rise reflects SBI's robust financial management and its commitment to securing the future of its pensioners. The pension and family pension payments by SBI have witnessed a steady rise over the years. From Rs 1,512 crores in 2015 to 16, the payout has grown to Rs 6,084 crores in 2024-25. This fourfold increase reflects SBI's ongoing commitment to the welfare of its retired employees and their families. SBI's financial performance has shown strong and consistent growth. Operating profit rose from Rs 65,136 crores in 2018 to 19 to an impressive Rs 1,10,579 crores in 2024-25. Net profit, which was just Rs 862 crores in 2018 to 19, surged to Rs 70,901 crores, reflecting sound management, improved asset quality, and operational efficiency. This robust performance underscores the bank's financial strength and sustainability. Unions are legally empowered to represent only serving employees. Retirees are not members and hence not represented. Pensioners' associations are the only dedicated voice for retirees. Since no recognized negotiation forum exists for pensioners, their exclusion violates constitutional rights like equality and dignity. The SBI pension scheme is separate and not governed by IBA settlements. Pensioners must be included in consultations, as affirmed by the government's own empowered committee. Their associations deserve formal recognition for all pension-related matters to ensure fairness and justice.
The table shows bank-wise number of pensioners as on 31st March 2023. There are approximately 6.06 lakh pensioners and 7.80 lakh family pensioners across 12 banks. Assuming an annual attrition rate of 3.5%, there would be about 12,150 new retirees per year, and the total number of SBI pensioners is projected to reach 2.31 lakh as on 31st of March 2025. Additionally, family pensioners are estimated at around 60,961 by the same date, leading to a combined total of approximately 2.92 lakh individuals. The age distribution of projected SBI pensioners as of March 2025 is presented. The 61 to 70 age group constitutes the largest segment, with approximately 1,39,000 recipients, followed by the 71 to 80 age group with around 82,600. The pie chart highlights that nearly half of all pensioners fall within the 61 to 70 age bracket. The additional annual fiscal impact of updating pension calculations has been provided. Based on current actuarial rates and assuming a rise in costs, the net additional annual expenditure is estimated to be around 1,680 crore rupees after deducting the ex gratia amount. Presuming that the updation of pension is approved with effective from November 2022, arrears have been calculated for the period from November 2022 to April 2024. under the updated pension formula. Of the estimated 2.92 lakh retirees, around 92%, or approximately 2.69 lakh, are eligible for arrears. Assuming an average monthly pension increase of 15,000 rupees for pensioners and 9,000 rupees for family pensioners, the average arrear per person is approximately 2.7 lakh rupees. Multiplying these figures yields a total arrears payout of around 7,269 crore rupees. A 15% rise in defined benefit obligation is assumed, requiring a one-time additional provision of 30,670 crore rupees. The bank's history of handling pension reforms, like family pension revision and DA neutralization, demonstrates its financial strength and commitment. With a net deficit already accounted for in the balance sheet, SBI is well positioned to absorb future liabilities, ensuring dignity and clarity for retirees. Pension fund balances of public sector banks as on 31st March 2024 have been furnished. These balances reflect the sector's preparedness for future pension commitments. This bar chart reflects a visual representation of pension fund balances across public sector banks. The scale of SBI's reserve stands out prominently, followed by Punjab National Bank, Union Bank of India, and others, underlining the sector's strong fiscal backing for pension liabilities.
In the landmark case of D.S. Nakara, the Supreme Court emphasized that pension must be updated over time, not only to ensure fairness, but to maintain dignity in old age. Financial constraints, the court declared, are not a valid reason to deny such rightful benefits.
In the Custody case, the court reiterated, pension is a deferred portion of earned compensation. It must remain fair and reflective of the real value of past service. The judiciary further stressed that all pensioners, irrespective of retirement date, form a single homogeneous class. Any artificial cutoff violates Article 14 of the Constitution.
In the landmark case of V. Kasturi versus State Bank of India, the Supreme Court held that if a person is eligible for pension at the time of retirement and is alive when the pension scheme is amended, he becomes eligible for enhanced pension under the revised formula. He cannot be excluded from the benefits of the amended scheme merely because he retired earlier. If the additional pension benefit is granted to a class of pensioners, then all members of that class who are alive at the time of the amendment are entitled to it, regardless of their retirement date. This principle aligns with the reasoning in the Nakara judgment, reaffirming that pensioners form a homogeneous class and must be treated equally. The issue of pension updation is currently under judicial scrutiny through ongoing legal cases. In SLP, Civil, number 5561 of 2016, filed by M.C. Singla and others in the Supreme Court, unions and pensioners challenged the Indian Banks Association's refusal to implement pension updation for public sector banks. The IBA argued that pension updation was neither appropriate nor financially viable. In response, unions demanded actuarial data and accused the IBA of misrepresenting facts, asserting that pension updation is contractually guaranteed under the 1993 settlement. Other important cases include WPC Nos. 1875 of 2013, 8095 of 2016, and 9679 of 2018. 2016, filed by the Federation of SBI Pensioners, Umesh Sharma, and Manohar Lal. These cases focus on key issues such as uniform payment of 30% family pension, which has already been conceded, 100% DA neutralization for pre-2002 pensioners, restoration of 50% pension with effect from March 1, 1999, and, most importantly, pension updation. These matters are currently under hearing and have been listed for final arguments on the 20th of August, 2025.
Denying fair pension to retirees, especially when it is granted to others, amounts to discrimination. An inadequate pension violates the constitutional right to life with dignity. Moreover, directive principles of state policy support the idea of assistance in old age. These principles further reinforce the moral and constitutional obligation of pension updation. Introduced from November 1st, 2012 under the 10th bipartite settlement, the special allowance is paid to all employees, attracts dearness allowance, and is not linked to performance. The Supreme Court in 2019 ruled that this allowance qualifies for superannuation benefits. The Kerala High Court's single bench ruled in favor of including it in pension calculations. International standards clearly support pension updation. The ILO Convention 102 mandates adjustments when the cost of living rises. ILO Recommendation 202 and the UN Madrid Plan of Action call for periodic reviews to protect retirees from inflation. The Universal Declaration of Human Rights affirms the right to a dignified, inflation-adjusted pension in old age. Countries like the US, UK, Canada, and Germany already index pensions to inflation. It's time for Indian institutions like SBI and IBA to align with these global norms and secure financial dignity for our pensioners. Indexation is not a choice. It is a necessity. First, it prevents the erosion of value. Without it, pensions steadily lose purchasing power. Second, it ensures social protection. Fixed pensions without adjustments cannot keep up with rising costs, especially for the elderly. Third, it aligns with basic human rights. The right to a dignified life includes inflation protection. And fourth, regular indexation strengthens public trust in pension systems and shows the state's commitment to retiree welfare. Due to pending court cases, pension updation remains stalled. As an interim measure, ex gratia payments have been approved from January 2022 to October 2027. However, these payments are subject to yearly reviews, with the next due in April 2024. Notably, no revisions have been made yet for the years 2024 and 2025, leaving pensioners in uncertainty. State Bank of India has been a cornerstone in executing the Government of India's flagship schemes, especially under the BJP-led administration. From financial inclusion to digital governance and green energy, SBI has translated policy into progress. As India moves toward the vision of Viksit Bharat at 2047, SBI stands tall as a trusted financial partner in building the nation. SBI officers have shown exceptional commitment during national emergencies like demonetization and the COVID-19 pandemic. Their resilience and public service go far beyond routine banking, reflecting a strong national spirit and sense of duty. SBI's strategy is closely aligned with the government's Viksit Bharat at 2047 vision. It focuses on pillars such as financial inclusion, rural development, MSME support, women empowerment, and digital transformation. During demonetization in November 2016, SBI officers played a frontline role, managing 15 lakh crore rupees worth of transactions efficiently and ensuring legal tender was available across rural and urban areas. They also worked with the RBI and government agencies to maintain public order amid intense pressure. In times of natural disasters like floods, cyclones, and earthquakes, SBI responded swiftly. It restored banking operations, deployed mobile ATMs, provided emergency loans, and contributed to relief through CSR initiatives. During the COVID-19 pandemic, SBI continued essential banking services even during lockdowns. Officers ensured smooth disbursement of pensions, subsidies, and relief packages. They facilitated emergency loans, supported healthcare financing, and implemented RBI-guided loan moratoriums, often risking their own lives to serve the public. Pension updation is about restoring dignity and justice to over 2.5 lakh pensioners, including many senior citizens above 75 years of age. A delay in action violates their fundamental rights to equality and dignity under Articles 14 and 21 of the Constitution. Regular updation will end long-standing discrimination and align with the BJP's vision for senior citizens, reflected in initiatives like PM Vaya Vandana Yojana, Enhanced Family Pension, and Ayushman Bharat. Pension updation in SBI is truly in the spirit of Sabka Saath, Sabka Vikas.
This is a plea for justice based on legality, equity, and ethics. Pensioners urge the authorities to act swiftly, ensuring that all retirees spend their remaining years with dignity, security, and justice. We call for the adoption of an honest litigation policy, because truly, senior citizens deserve timely justice. Presentation by Umesh Sharma. On behalf of Group of Pensioners, State Bank of India, the presentation is conceptualized and created by S. Satyanarayana, Chief Manager, Retired, Hyderabad, mobile number 98497986563.